Dividends matter. Another major factor in the rise of speculation was the gradual diminution of dividends as an important part of the investment return equation. Even during the 1930s, with portfolio turnover at but a fraction of today's level, Lord Keynes observed from his vantage point in London that, in one of the greatest investment markets in the world, namely New York, the influence of speculation is enormous. It is rare for an American to invest for income, and he will not readily purchase an investment except in the hope of capital appreciation. This is only another way of saying that he is attaching his hope to a favorable change in the conventional basis of valuation, i.e., that he is a speculator. While that same influence of speculation prevails today, Keynes could not have imagined either the soaring turnover or tumbling dividend yields in the United States. Historically, dividends have accounted for almost one-half of the market's return. About 5% of the stock market's 10.5% long-term annual return, with the remainder accounted for almost entirely by earnings growth averaging about 5% annually. Yet the dividend yield on U.S. stocks dropped to 1% in early 2000, a reflection of the counterproductive investor attitude. During an era in which stocks were held for growth, income didn't seem to matter. Even in early 2005, the dividend yield remains at an astonishingly low 1.8%. It is argued that U.S. tax policy makes dividends a less efficient way to distribute corporate profits than buying stock back in corporate repurchase programs, and there is some truth to that. Nonetheless, it is ironic that the steady decline in the dividend payout rate occurred during an era in which pension funds and mutual funds became the dominant owners of stock. Dividends received by pension funds are completely exempt from taxes. In equity mutual funds, management fees and expenses consume about 80% of dividends, leaving only 20% remaining for fund owners, some one-half of whom, in any event, hold their share in tax-deferred retirement plans. Fund portfolio managers paid on the basis of pre-tax returns are notoriously unconcerned about the tax costs borne by their fund shareholders on dividends and capital gains alike. Dividend policy. A distinct advantage of dividends is that the income-oriented investor is less likely to be seduced by Mr. Market's daily siren song. In theory, by relying on dividends that are steady and over time growing, the income-oriented investor ought to be inclined to hold on to his shares. Experience confirms this theory. The owners of dividend-paying stocks have twice the staying power of holders of non-dividend-paying stocks. Turnover in stocks that pay no dividends now runs at an average rate of 175% per year. Turnover in stocks that pay dividends runs about 85% per year, only half as much, albeit quite high enough. So if stock owners demand that corporations place much more focus on dividend payouts, the market's emphasis on the speculative element of stock returns should begin to abate. Investing for income is a long-term strategy. Investing for capital gains is all too often a short-term strategy. Such an outcome, however unlikely it may seem today, is by no means impossible. Indeed, the sharp reduction of the tax rate applicable to dividends, essentially to a maximum of 15% in 2003, already seems to have given some impetus to increased dividends. Investor owners ought to foster that embryonic trend, pushing corporations as appropriate to step up their dividend payouts and work to restore dividends to their traditional importance in the investment equation. Despite the absence of evidence that earnings retention leads to sound capital allocations, the dividend payout rate has been in a declining trend for decades, tumbling from a norm of about 50% during 1974 to 94 to only about 30% during the past 10 years. Yet, history tells us that higher dividend payouts are actually associated with higher future returns on stocks. In 2003, Robert D. Arnott and Clifford S. Asness wrote, "The historical evidence strongly suggests that expected future earnings growth is fastest when current dividend payouts are high and slowest when dividend payouts are low, which contradicts the view that substantial reinvestment of retained earnings will fuel faster future earnings growth. This conclusion is consistent with anecdotal tales about managers signaling their earnings expectations through dividends or engaging at times in inefficient empire building. Our findings offer a challenge to market observers who see the low dividend payouts of recent times as a sign of strong future earnings to come. Typically, the future earnings growth of the lowest payout firms, about 3% annually, lagged the growth of the highest payout firms, 7.5%, by an astonishing 4.5% per year. Earnings are conjecture. Cash is fact. Further, as dividends return to their deserved place in the sun, reliance on earnings as the key measure of stock valuations should recede. Lest we forget, dividends, at least dividends well covered by prospective earnings, are real, in contrast to those illusory earnings per share that are manufactured each quarter, whether under the rubric of generally accepted accounting principles or not. Even in those cases in which earnings are honestly administered, the calculations depend on myriad estimates and assumptions of future events unknown. The focus on corporate earnings above all else has led us down the primrose path to unwise capital commitments, to mergers done solely for financial reasons and without business rationale, and to that misbegotten financial engineering that was, as we now know, a triumph of form over substance. Dividends, on the other hand, remind us that cash is king and plays a major part in the creation of long-term returns. A return of dividends to their formerly high standing would do much to reduce today's high turnover and excessive speculation. Earnings are conjecture, cash is fact. Curbing speculative excesses. The price paid by investors for the speculative ethos of our financial markets is sufficiently high that, as a matter of public import, policymakers should consider developing differential tax strategies aimed at stemming excessive speculation. Way back in 1986, Warren Buffett suggested a 100% tax on short-term capital gains paid by all investors, not only by taxable individuals but also by tax-exempt pension funds. Although a tax at that rate might seem a tad extreme, perhaps a 50% tax on very short-term gains on trading stocks, scaled down as the holding period lengthens, would help to bring investors to their senses. Buffett says that idea was put forth tongue-in-cheek, but with stock market turnover having risen from a mere 25% when he expressed his opinion to 150% in 2004, perhaps he'd be serious about it now. And why not consider the creation of a special class of stock that rewards investors with a premium dividend on the shares they have held for longer than, say, 1 year? If we have the will to foster a long-term focus by investors, we can find the way. Changing the speculative mindset of investment managers also would be abetted by the development of new forms of investment advisory contracts. For example, contracts that remain effective for much longer periods than today's typical 1-year duration, subject to cancellation on shorter notice, to perhaps 3 to 5 years, albeit with immediate termination clauses for extraordinary events. Contracts that clearly define manager mandates, and contracts that reward managers for long-term achievement in which premium fees are paid for returns that exceed appropriate benchmarks and penalty fees imposed for returns that fall short. While such incentive contracts are virtually anathema in the mutual fund field, as shown in Chapter 9, they are widely used in public pension funds. But because smart managers prefer to be paid generously whether their performance is good or bad, corporations and fund directors will have to demand pay for performance if they are to get it. Finally, the financial community ought to make a major effort to enhance the understanding of our citizen investors that enormous long-term penalties are engendered by short-term trading. The toll taken by the costs of our system of financial intermediation include not only those onerous turnover costs, but the taxes extracted by our system of federal, state, and even local taxation. For taxable investors, taxes imposed on the huge short-term and long-term capital gains realized during the late bull market had a devastating impact on their pre-tax returns, taxes that were willingly, indeed almost callously, incurred on their behalf by their money managers. Over an investment lifetime, this drain of unnecessary taxes may easily spell the difference between triumph and disaster in the accumulation of wealth. If there is a single principle that individual investors should understand, it is this eternal reality of investing. The returns earned by investors as a group will inevitably lag whatever returns our financial markets are generous enough to provide. That lag is precisely equal to the amount of the costs they incur through our system of financial intermediation and the taxes they incur on dividends and realized capital gains. Yet most investors seem oblivious to the actual toll that costs and taxes take over their investment lives, a state of ignorant bliss that our fund managers have been pleased to accommodate. Investors must understand the simple mathematical reality. If the stock market delivers an 8% return over the next 50 years, $1 compounded will grow to $47. Even a minimal 2.5% deduction for costs and another 1.5% for taxes would result in a net return of only 4%. Compounded, that same $1 grows to $7, only 15% of the optimum return. Surely our society pays a price when, simply because of the costs of investing and the taxes on investment activity, the investor takes home less than 1/3 of the market's long-term return. Once investors realize that short-term speculation is costly folly and that long-term investing is priceless wisdom, and then select only those portfolio managers who shun the former and rely on the latter, the financial system will fall in line accordingly and promptly.